There's a Canadian account that gives you a tax deduction when you put money in and lets you withdraw completely tax-free. No other account does both. But there's one mistake people make with it that permanently costs them thousands of dollars, and you can never undo it. I'm Brandon from Life Money. Today, I'm breaking down exactly how the FHSA works, the contribution limits most people get wrong, and the trap you need to avoid before it's too late. Let's get into it. If you're saving to buy your first home in Canada, there's a government account that could literally save you thousands of dollars in taxes, and most people don't fully understand how it works. I'm talking about the First Home Savings Account, the FHSA. It was introduced in April 2023, and it combines the best features of both an RRSP and a TFSA into one incredibly powerful account. In this video, I'm going to break down exactly how the FHSA works, how much you can contribute, how the tax savings add up, and the one mistake people make that costs them thousands. Let's get into it. The First Home Savings Account, or FHSA, is a registered account specifically designed to help Canadians save for their first home. Here's what makes it special. It gives you two tax advantages at once. Just like an RRSP, your contributions are tax deductible. That means every dollar you put in reduces your taxable income, and you get a tax refund. And just like a TFSA, your money grows completely tax-free inside the account. When you withdraw to buy your first home, that withdrawal is also completely tax-free. No other account in Canada does both of these things. That's why the FHSA is one of the most powerful savings tools ever introduced in this country. Now, who can open an FHSA? You need to be a Canadian resident who is at least 18 years old. You must be a first-time home buyer. The CRA defines this as you have not lived in a home that you owned at any point in the current calendar year or the preceding 4 calendar years. So if you owned a home and sold it 5 or more years ago, you may actually qualify again. And importantly, you need to open the account before you buy your home. You cannot open it after the purchase and retroactively claim the deduction. One more thing. You can only have one FHSA open at a time, and it must be with a qualifying financial institution, your bank, credit union, or brokerage. Here's where it gets really interesting. You can contribute up to $8,000 per year to your FHSA, and the lifetime maximum is $40,000. But here's a feature that catches people off guard. Unlike the RRSP, you do not need earned income to contribute. Anyone who qualifies can put money in, even if they're a student or have a lower income year. Now, there is a carry-forward provision, but it works differently than you might expect. If you don't contribute the full $8,000 in a year, you can carry forward only the unused portion from the previous year. Not multiple years, just 1 year. So the maximum you can ever contribute in a single year is $16,000 if you contributed nothing the year before. This means the sooner you open your FHSA, the sooner the carry-forward room starts accumulating, even if you don't deposit any money right away. Open the account first. That's the key. Let's put real numbers on this. Say you earn $80,000 and you contribute $8,000 to your FHSA this year. At that income level in Ontario, your marginal tax rate is approximately 31.5%. That $8,000 contribution creates a tax deduction, meaning your taxable income drops from $80,000 to $72,000. At 31.5%, that's a tax refund of roughly $2,500 this year alone. Now multiply that across 5 years of maximum contributions. $40,000 contributed, tax deductions adding up. Depending on your income, you could be looking at $8,000 to $15,000 in total tax savings just from the deductions, on top of all the investment growth being completely tax-free. That's why this account is such a game changer. Now you might be asking, what about the home buyer's plan? The HBP has been around for decades and lets you withdraw up to $60,000 from your RRSP tax-free for a first home. Here's the key difference. With the HBP, you must repay the money back into your RRSP over 15 years. If you don't, the repayment amount is added to your income and taxed. With the FHSA, your withdrawal is completely tax-free and there's no repayment required. Once the money is out and used for your qualifying home purchase, it's done. The great news is you can use both in the same purchase. Use your FHSA and use the HBP on top of it. That could be $40,000 from your FHSA plus up to $60,000 from your RRSP, $100,000 combined for your down payment. Here's the mistake I see people make constantly, and it costs them thousands. They wait. They think, I'm not buying a home for 3 to 4 years. I'll open the FHSA when I'm ready. But here's the thing. The moment you open the account, contribution room starts accumulating. If you wait 3 years to open it, you've permanently lost the carry-forward room from those years. You can never go back and reclaim it. Opening the account today, even if you don't put a cent in it, starts the clock. That's free carry-forward room just waiting for you. The second mistake, putting the money in and leaving it as cash. The FHSA is an investment account. You can hold ETFs, mutual funds, stocks, GICs. If you're 5+ years from buying, your money should be working for you. Even a simple low-cost index ETF inside your FHSA will compound significantly over that time. Let's wrap this up with your key takeaways. Number 1. Open your FHSA now, today. Even if you're not contributing money yet, every year you wait, you're losing carry-forward room you can never recover. Number 2. Maximize your $8,000 annual contribution if you can. The tax refund you get back is essentially free money from the government to help you save faster. Number 3. Invest your FHSA. Don't leave it sitting in cash. A simple diversified ETF inside your FHSA will grow completely tax-free. Number 4. Combine your FHSA with the home buyer's plan for maximum down payment power. Up to $100,000 combined, tax-free. And if you want to run your own numbers, I have a free FHSA calculator over at calculatorsmax.com where you can model out exactly how much you could save based on your income and timeline. Link in the description. Go check it out. Thanks for watching. And if this helped you, subscribe because we cover Canadian personal finance every week.